Good afternoon, everyone, and welcome to part three in our four-part series on underwriting, hosted by ALU and Gamma International. This is Gonzalo Garcia from Agency One in Arlington, Virginia, and a longtime member of ALU. Today's conversation is about navigating the now, underwriting series part three, flash forward. Today I'm joined by Colin Devine. Colin is a senior analyst at Health Catalyst Capital, venture capital fund that invests in high-growth insurtech-enabled businesses, and a research fellow at the Alliance for Lifetime Income. Colin is also a former Smith Barney Citigroup sell-side equity analyst in the insurance sector. Welcome, Colin. We also have Trey Reynolds. Trey is an executive vice president at the MIB Group, a 125-year-old company that has been a leading force for accurate risk assessment. He was also the former head of distribution at Equitable, formerly AXA, and a sales vice president at John Hancock, covering the M Group account. I had the pleasure of working with Trey at the Bisis Group, which is now Crump, where he was influential in building much of the systems and platforms used in a multi-carrier brokerage organization. Trey brings multiple perspectives from the industry to this conversation, and welcome, Trey. Good to have you. Before we get started, I'd like to remind everyone that to visit the COVID-19 Action Center on AALU.org and gammaweb.com for timely updates and replays of all the webinars that have been hosted over the past several months during this crisis. Gentlemen, again, welcome and thanks for being on the webinar. Today we're talking about what's next in our attempt to flash forward relative to underwriting. Let's start with Colin. During our prep call, Colin, you indicated that COVID is not a mortality event as relates to the insurance industry. And we've talked a little bit about this in some of our previous calls. So can you elaborate on that? And let's just kind of do a level set here.
Sure. You know, with respect to it being a mortality event, it's not to say it's not a very serious event, but it's not a mortality event along the lines of, say, the 1918 Spanish flu when we lost 20% of the world's population. So it's not to diminish, you know, the severe hardship and casualties it's caused, but it's not, you know, it's not the Spanish flu. You know, that said, it may not be a mortality event for our industry. That doesn't mean it's not an event. And where it plays out for life insurers is what it's done to interest rates. You know, we think back to the financial crisis, you know, that's all on everybody's rearview mirror. Well, I'll tell you what, it's not for any of the carriers you deal with, because if you think going into that, rates on 10-year government bonds were about 5%. They lost about 200 points on that. And then they didn't recover that. Then going into COVID, you know, they're at about 3%, and now they're under 1%. You know, the 10-year today is about, 67, 68 basis points. And so, you know, the impact of low rates on life insurers, you know, is very significant. Obviously, we price products with very long-dated guarantees. We make very long-dated assumptions about where we will invest renewal premiums. And clearly, that's not working out so well when companies are having to put, you know, invest out there at hundreds of points below where they priced. The other thing that you're seeing through, you know, COVID, you know, is a downturn in the economy. You're seeing that on rating downgrades, not on carriers per se, but on the bond holdings they have. As the ratings go down, the capital requirements go up. So there's kind of two squeezes happening. There's the squeeze on, you know, from interest rates on spreads, and there's a squeeze on capital from bond downgrades, and they need to hold higher capital requirements, and, you know, they all want to maintain that RBC. So that's what's going on.
Right, and so, you know, because of the lower interest rates, Colin, just to kind of explain a little bit deeper here, because of lower interest rates, it's more expensive to reserve for long-dated guarantees. And of course, we had the impact of PBR at the beginning of the year, which, you know, created some changes. Can you just touch on that for a second?
Sure. It's more expensive. I mean, you just have to think about it. You know, let's unwind a life insurance policy, right? You're basically, you know, we'll put aside the mortality pooling component, okay? But, you know, you're looking at, I'm gonna price it based on how many premiums I'm gonna collect over, let's say, Gonzalo, and you the next 50 years to pay a projected death claim, right? We know what that's going to be in cash, and I've got to generate enough investment returns plus the premiums to pay that. You know, the returns that I'm earning off a 10-year at, let's say, 70 basis points, or maybe buying corporate bonds that yield 3. The problem with that, if I told you the policy back in 2006, I was probably assuming 7. Going into COVID, I was probably assuming 4.5 to 5, and I'm getting 3. And that's an issue. And so as people think about where do you see it play out? Okay. We're going to get to pricing later, but you certainly see the impact of low rates play out in policy dividends. And, you're also seeing it play out with some carriers onto COI adjustments.
Yep.
And you can walk, both of those triggers have been low rates. And this decline's been going on for a long time, but we're into a low for forever environment. Nobody ever foresaw this. 2006, they thought rates had bottomed. Where do they bottom? I don't know.
We are 14 years later having the same conversation. So,
it's not looking good.
Yeah.
It's good for your mortgage. It's just not good for your life insurer.
Yeah, true. Hey, Trey, you spent a number of years in the industry and recently moved from Equitable to MIB. And I'd ask you kind of the same question when you were on the carrier side and COVID hit, right? Clearly there were a lot of conversations going on in the boardrooms and within the four walls of AXA or Equitable at the time. And so what were you guys seeing? What were you talking about? What were you guys thinking through from a carrier perspective?
Yeah, thank you, Gonzalo. It is fascinating because a lot of what Colin is saying, it was happening, of course, in the dialogue we had on the sales side with the life insurance division specifically. And it was this, this balance between the cost of our products and offering the products we have. And then, of course, you had the pressures on the underwriting side with all the changes in underwriting. If there's one thing that I would say about our industry, when it comes to events like this, it is incredibly effective at looking to identify potential risks and trying to plan for those risks. This one specifically, though, really was around how do we understand the risks, but then how do we maintain a sales momentum going in through the summer, not knowing how long this would last. And then, as Colin just articulated very well, how do we make sure that we're mapping it up with products that we know could be sustainable longer term? So if you look back, you had actions on the product side of lowering caps on IUL. You had potential products coming out of the market. You had potential increases on premiums. You had in-force books that may not be performing as much. So a lot of things going on that insurance manufacturers and carriers are trying to plan for and predict. But when it came down to the discussions around sales and sales momentum, it was really around, okay, how do we make sure that we can get information to our underwriting team that provided them what they needed to assess risk and be competitive. So the way that I evaluate it is when you're losing the most predictive requirements, which is blood and urine, how do you then replace that with information that gives an underwriter the ability to assess a risk, to deliver an expectation to a producer and a client in a way that keeps you in the market? And that's where the focus really shifted, while underwriters were, of course, trying to figure out that over age 70 and impaired risks have more risk and everything else. But the resiliency in the conversations on a day-to-day basis was really around that experience. How do we keep people engaged with the products that we want to offer? How do we do it so we don't create an experience that puts our industry even in a worse position, right? Not putting labs and examiners inside homes. How do we find out what solutions we can get to make that happen, and then size the opportunities so that manufacturers and carriers aren't taking on unnecessary risk?
Yeah. And Trey, as I've known you a long time, so I was you really piqued my interest when you made the move to MIB, and MIB is basically owned by the industry and is a utility for the insurance companies. As you're getting into that, without getting into all the strategic directions, but what's changing? What's happening strategically in the industry? And we're going to spend a lot of time on technology and other things like that relative to underwriting, but what are you seeing with your MIB hat on? Because I'm very interested in that. I'm sure everybody on the call is as well.
Yeah, it was a fascinating process for me, and of course the title of the panel today is around flashing forward. And MIB is a fantastic example of how our industry is looking to invest and look for opportunities to make sure that we're delivering on the needs of our customers for a long time in the future. MIB, as you mentioned, is a 120-year-old company. And over those 120 years, you're probably all familiar with the services that we provide, which is the coding platform. We call it the fraud checking services. And that is a data exchange where members from 1902 on would provide data to anticipate that applicants would go from carrier to carrier, maybe not all of the information on an application. They would use that data to make sure that the application matched the experience in the industry. And that's used, we're owned by 400 carriers in North America. That's 99.9% of all of the members. Our board is represented of the senior folks in our industry. And the decision was made that coding platform isn't enough to really accommodate or participate in the changes we're seeing as we're moving forward. And that has been accelerated, of course, with the changes we're seeing with the pandemic. And so bringing Brian Winikoff in to really help lead a transformation and providing value beyond the coding platform. And if you think about MIB going forward, at least I hope you think about MIB going forward, it's going to be around identifying value-added services inside, underwriting services specifically. So think about expanding checks. We've recently rolled out our EHR platform, electronic health record platform, which we'll discuss in a little bit, but it's really continuing to evolve into leveraging data so we can help our members, which are all of the carriers in North America, drive better opportunity to drive more efficiencies, super critical with what Colin addressed earlier today. Yep. Help our carriers manage risk, also very critical to squeeze out any possible profitability in the products we're selling. And importantly, which is a newer one, is around growth. How can we leverage the data that we have today to help carriers and, of course, the folks on this call identify opportunities to increase wallet share, or, of course, just identifying new clients and sell more product?
Yeah, and it's interesting you say that because we're going to spend a lot of time talking about efficiencies. And, Colin, as we kind of get a little deeper here, and I wanted to a little bit set the stage relative to kind of the environment and the pressure that's going on inside the industry, both financially and, Trey talked about sales momentum and keeping the machine moving, right? So we need to continue to get that premium coming in. And then you've got the challenge of where do you invest it, right? So the pricing pressure and efficiencies required in today's environment are really important. And so I would ask you to comment on the impact of what you brought up before around low interest rate environment and some of the things that Trey talked about, making sure we have good underwriting information. You always say in all the conversations I've ever had with you, these are 20, 30, 40-year mistakes, and you don't get a mulligan on these. So, how do you deal with that as you're going forward? And let's get into kind of efficiencies and product pricing.
Okay. First, I would say, when you think about our industry, first, second, last, it's all about underwriting.
Yeah.
Right. Like there's nothing more important in our industry than underwriting. It's where the buck stops. Right. It's the old, measure twice, cut once, probably measure 100 times, cut once. And it's certainly been the part of our industry that's probably been the most cautious to change. Okay. To sort of getting into pricing pressure and efficiencies, let's just step back for a second and just go, okay, how do companies make money? Right. If you're reverse engineering a product, it's basically on your traditional, UL whole life, it's on spread, right? What am I going to make on interest rates? It's on lapses. It's on mortality, morbidity, maybe on some of the riders, and expenses. That's it. Okay. Well, let's look at spreads. How's that going? Not so good. Right? Spreads are negative. Yeah. Right? They're negative. Right? And that's likely not going to change for a while. Obviously, new products you're going to have to price in this kind of rate environment. But for the imports, right? So then what else? Lapses. Well, where are lapses going? If you think about, as rates have come down, the price of many products and like insurance, annuities goes up. Lapses probably aren't necessarily going to go our way, right? In an economic downturn, through history, you haven't seen lapse rates go up. So lapses are probably not going to be a favorable variance either. Okay. Mortality. Well, everybody prices, assuming some improvement in mortality, right? And the industry nailed that. We've done that for a long time. I'm running out of the four options here, right? So then I'm down to expenses, right? So I better get a heck of a lot more efficient because I can't call up the investment department to kind of bail me out.
Right.
They did it for a long time. And so what are you seeing as you look at that? And you and I talked, it's real, it's right. We talked about this. I mean, you saw carriers stop new issue, at age 80, they dropped it down to age 70.
Yep.
Why'd they do that? Because somebody age 80, if I got a 70-point tenure, I can't invest at enough of a spread, right, to earn a return to pay any kind of death benefit at a price that you would even return a phone call on, right? So
Yeah, it really wasn't about 80-year-old. While older people are certainly more at risk as a result of COVID. I mean, it was.
No, it's not that.
It was more amplified by the fact that you've got 10 years, maybe the life expectancy. You just can't make enough money.
I can't make enough money in 10 years.
Yep.
I need a runway of 20, right?
Yep.
10 just is not going to do it at any price that would make sense, for anybody. And you're seeing this also as companies, again, this is not new news to anybody on this call. You've seen lots of carriers get out of lots of business lines or de-emphasize parts of business lines, right? I mean, I know we're talking a lot about life insurance, but, long-term care is kind of a poster child. How many writers are left there? Variable annuities, again, they're actually very interest rate sensitive. Go back 10 years, 15 years, how many of the top 10 companies are still in the top 10? The answer is 3.
Yeah.
Right? And you've seen some fairly dramatic strategic actions taken by some companies, met with Bright House, Trey's former company, Equitable, leaving AXA. Voy has done that. Heck, Legal & General did it, many years ago. Or not Legal & General, I'm sorry. It was former owner of Ameris. Anyway, so you've seen lots of significant corporate decisions, right?
Yeah.
That's not going to change. I can tell you right now, because again, some of these companies are stuck with these in-force blocks that there's really no way to get a genie back in the bottle. And that limits then your ability to do other things, right? So where do you see that? As I say, you see them getting out of products or certainly becoming less aggressive. They switch to fee-based, right? Versus taking the spread risk. So you get away from the being crushed by low rates.
Yeah.
Policy dividends, how those going, right? Down, down, and down. COIs, I remember several carriers who told me, Hades would freeze over before they ever did that. I guess it has. Yep, pretty much has, right? This is nearing, again, hits close to home. And you're going to continue to see that. You're going to see companies maybe divest, businesses, that end up in the hands of different owners, and the concerns that can have that may be different than the company you sold the product from.
Yeah.
So this thing is going to go on for a while. It's going to unfold various ways. On the other hand, our industry is great at adapting. We're a long game, right? We're not a short-term game. We play a long game, and we have the benefit of that. We have the benefit of cash flow, right? The premiums keep rolling in to adjust to that. And just like we've come up with new features, like accelerated death benefits on life policies to help with long-term care, I think we'll continue to do that. And I think there's a huge opportunity here, but we have to get a lot more efficient, and we need to make life insurance, it probably ranks now as the most unappealing product to buy in terms of a sales process, right? It's probably number one, and that's not really where we want to be. And that's why, as an industry, when was the last time sales grew?
Yeah.
In our lifetime?
Well, Colin, and I think what I'm hearing from you and what I heard from Trey is that if nothing else, we have to find efficiencies as an industry for, not only distribution, but clearly where the rubber hits the road is make sure that We take advantage of the technology that's kind of coming out, and that's kind of the rest of our conversation, right? And it's really where kind of the fun and exciting part is, and our flash forward part here. But there's a lot of efficiencies that are going to be driven by the technology that we're going to spend probably the rest of our time talking about. And I think that's where the exciting part of it is. And it's there. You and I have had this conversation a lot. Let me transition over to Trey for a second. So, in the spirit of finding efficiencies and processes, which leads to kind of the right underwriting, we're going to get to consumer experience here in just a minute. But, from MIB's perspective, what's MIB's role in underwriting today, and where do you see the opportunities, again, maybe not specifically for MIB, but for the industry, kind of in what's happening coming out of this pandemic relative to underwriting?
Yeah, just a couple of points. One I'd make to support what Colin was saying before I start, and that is that you probably all saw the article from Think Advisor, or maybe it was published in other places as well, where Sun Life had commented that the best decision, and maybe I'm being overly dramatic, but the best decision they made was the best of the U.S. businesses for growth in Asia and other countries. That certainly is something that we need to be aware of and think about. And then the second point, which will lead into this efficiency conversation, and that is if we've got the sense that the life insurance product lines are not creating the return required to compete with other products that are being offered by our carriers and manufacturers, then we've got to find a way to raise that a little bit. We want our carriers to be profitable on life insurance. And so we need to find ways to make them profitable in a lower interest rate environment. Look, this industry has been so resilient over the years, and solutions will be found to deliver product that's profitable to our carriers, in addition to, of course, providing a living for many of us who sell insurance and creating a better overall experience. And as Colin suggested, the one lever that we have is around the overall efficiencies of how we deal with products. So when you've got competing interests, you've got insurance carriers that are looking to allocate less money potentially to life insurance products for the reasons Colin illustrated, which could mean lower technology budgets to invest in certain innovations. They're looking to lower staff that help service some of the books. Maybe it's in force, maybe it's in the new business or underwriting side. And I think that, as the number of transactions or applications go down, of course, you've got to find a way to support fewer transactions at a lower overall cost. And that's right at the intersection where MIB and a lot of other great insurtech companies are looking to play. I would say the one thing that's changed is that, in the old day, and remember, in the old day when people felt that carriers had unlimited funds, were willing to invest in certain projects, and look, the fail rate may have been pretty high, or at least not translating into a specific efficiency or benefit to a carrier. Those days are definitely getting smaller, and fewer. You've got to come in with solutions that have the demonstrated impact early on in the process. The 2 to 3 to 4 year sales cycle before you have some kind of payback or demonstrated benefit is gone. And so when you think about the areas that we want to focus on as an industry, and I would say MIB specifically, again, underwriting services, it's trying to get all of the data that an underwriter needs to make and assess the right amount of risk. So in the past, underwriters, the more data the underwriters had, the better. I think Colin is the one who introduced me to that concept. Well, we've got to get them comfortable to assess that risk properly, but how can we get that data to them that's digestible in a very efficient, effective way? And not every insured needs all of those pieces of data. So how do we get into, I think a lot of people talk about automated underwriting. I hear more from carriers about personalized and customized. Yeah. So we have an insured, how do we start drilling down and knowing who that client is, and then start reaching through the data and pulling up data that is necessary to underwrite that risk? And that's all the data is necessary risk. None of the ancillary data that creates noise and creates costs and inefficiencies and everything else. And where MIB serves well is the ability to focus exclusively on the data, the cleansing of the data, and then the application or the pipe that goes into our underwriters to help serve that data. And then what I get excited about, and when we talk about the future and what's going on with some of the pandemic now, just by doing that, the experience changes so dramatically for people buying insurance and for producers. The hope is that those who sold life insurance long ago and have moved more towards wealth management because they know the protective value of life insurance. They know that as a fiduciary, they want to provide it. The experience has driven them away. Well, now we can actually maybe do something that brings them back in, and they're doing the fiduciary responsibility by including risk products. You're going to see a lot of effort in that underwriting services efficiency area right now, very quickly. And then ultimately, the other side of it is going to be on the in-force, which of course can be a discussion for another day. How do we leverage data more effectively on the in-force?
We're going to talk a little bit about that towards the end. But, what I'm hearing you say, Trey and Colin, is it's all about data and analytics. It's all about, how do we create this process to be way more efficient, which will ultimately lead to a much better customer experience, not only on the underwriting side, but we need to make insurance fun to own again. So we're going to spend a little time on that. But Colin, you've been very, very involved on the InsurTech and health tech side. And you've got a lot to say about this. So what are you seeing? I mean, we talked the other day about the VA and Social Security Administration, which blew me away, right? So
Yep.
talk to me.
Okay. So, and I wanted to build on, just as I do that, so, what Trey said is it's, you have to, with data and underwriting, right? It gets down to what you need to have to make the underwriting decision and what's nice to have, and separating that, right? It's nice to have everything. Okay. And when you mention efficiency, what is efficiency? Efficiency in many cases means speed,
Yeah.
right? We have to deliver, and to sort of, maybe it's an overworked term, but in industry, we have to deliver an Amazon type experience, right? Nobody today is going to wait 3 months to buy a product. So it shouldn't be a surprise to us as an industry that sales continue to go down, because that's what we deliver. And that has got to go. So let's talk about, InsurTech, something that I love, because tech, frankly, our industry, if, sometimes joke, if we get up into the last century, it'd be good. Maybe when we get into this one, be nirvana. But first and foremost, I'd say tech is an enabler, right? It's not just about, expense efficiencies for insurers. It's not just about the faster sales process. Tech actually can let our industry, who really does have aligned interests with policyholders, live longer, happier lives.
Yep.
Right? There's every life insurance company to deal with would really love you pretty much on pretty much all products. We won't get into once they don't live to be 100, live to be 110. Like, just keep going, right? And embracing tech within the underwriting process, right? And the ongoing engagement process. It's both. It's how you can do that, and that loops back onto the sales process, because tech you can, again, for every agent on here, right? Tech efficiently implemented can also create opportunities to upsell a client as their needs change down the road on a very efficient basis. So, there's a lot out there. Now, in terms of sort of, if I look at one segment of the system, right, that I say it should change, it has to change. As an industry, we're a DOA if it doesn't. And that's going to electronic medical records, right? It's not going to solve, Gonzalo, for you, every single case.
Right.
But I'll tell you what, right? They can solve at least 70% of the cases your agency underwrites.
Which Colin cuts, the APS ordering process is the longest process conceivably.
Correct.
Underwriting process. So if you trim that down to minutes or a day or two, I mean, you're now starting to hit the kind of efficiencies we talked about. So I'm sorry.
Right. And that's the key, right? And you can't. And that technology is there now, right? Again, it may, by the way, because you can get the health record, right, in less than a day, it will indicate very quickly, right? Is this a case where life insurance, the person's uninsurable, so let's find a different solution? Is it a case where it indicates very quickly, here's where we want to go deeper, not just, sort of shotgun it, like rifle in on where you want to go. So, you can make decisions. By the way, they impact claims management, right? In terms of, disability determination, long-term care determination, workers' comp determination, right? And as you pointed out, that's the choke point in this whole process, right? I mean, I was astonished that of the 3 months you spend putting a case on the books, getting it through approval, actual underwriting, I'm told on average is less than 10 hours. So where's the other time going? Most of it's going getting the APS
You're waiting.
and scheduling the paramedic.
Yeah, you're waiting. for
And both of those can go out the door tomorrow.
Yeah.
Right? And that's there. So, where is this sort of, why is this not theory? Why is it reality? Well, and this is when everybody's, fall off the chairs. Who would think the government could be ahead of all of this? But the government's been using electronic health records for over a decade, right? Social Security disability benefit determination is done off EHRs. The Veterans Administration runs off these things. So it's not, if they can do it, again, I come back to why can't we do it? And again, it may not be every single case.
Right.
But it's a lot more than zero, which it is now. And the number will be, it's easily over 70% of cases you could do off, electronic health records. So that's where it makes a big difference. Now, there's some variability by state, but not much. What underpins this at a clinical level is health information exchanges. That's what the government's using for Social Security and VA. That sort of gets into what's called interoperability, that medical records should be able to whip around the country, instantaneously. I think we've all seen through COVID, that's not been the most efficient process. If it was, right, the CDC would have been on this thing, a lot earlier and a lot more efficiently than they were. But COVID's also provided an impetus for that. Right. And so what, Social Security, these HIEs, and they're, most of them are nonprofit. But the impetus to share data and a permitted use for these things is life insurance underwriting. So it's tapping into it. Now, health data, health records look a lot different than what the average life insurance company is tracking. So you got to, just as MIB does, sort of aggregate data and get it to carriers. It's the same idea. Okay, you got to get it from all these HIEs, and there's probably 65 major ones across the country, and get it into a digestible, consistent form that a life insurance company can then absorb. But absolutely, these things, kind of think of them, an analogy might almost be like a credit bureau.
Yeah.
Right? They pull all your data, right, from all the doctors you've seen. And again, they can deliver those records in under a minute.
Yeah. Well, I mean, Trey, to you that this has to be, music to your ears, right? I mean, you guys are fundamentally a data company, and I suspect that what Colin is saying is no surprise to you. So, maybe from MIB's perspective, again, as you guys have built out some tools and some other processes, tech investment at carriers, in our prep call, I think Colin said tech investment at carriers is going down. So, clearly the outsourcing process to an MIB is a real opportunity for you guys.
Yeah, it definitely is. And of course, again, it's great to be working for a firm that helps support the noble purpose of life insurance by providing data to help identify and help assess risks. And I mentioned the coding, which everyone's familiar with. Also, there's information we provide on criminal backgrounds, some pre-MVR check to save money if they don't need the full MVR. Same exact comment that Colin was making. How do we directionally get enough information before the carriers make the bigger investments to get the information, continue to assess risk, and that's what we'll continue to do on the MIB side, is be that utility for our members that really helps them access and attract data. And to Colin's point, while this may be the catalyst, COVID and of course the other movements has been mentioned relative to the 10-year being down and pricing challenges and everything else, we've got a long ways to go to really create a nice way to present data on a customized and personalized basis by insureds. Colin mentioned specifically, EHRs aren't the same as an APS, and that's very true. There's often not notes in an EHR. There's often, not data around maybe some EKGs or some things that have traditionally been very important to that process. Exchanges hold a lot of the data, but the exchanges differ from state to state, from government entity to entity. You have software companies, which are the tablets or hardware and software, the tablets being used by doctors that are collecting it. Those companies are interested in being part of the overall exchange. You have consumers who own their own records. And so, right now it's really an arms race to try and get as much data as you can, get the hit rate, as we describe it, as high as you can, so that when a request is made, our carriers, our members can be, really assured that they're going to get all the data in a file and at least make a decision going forward. And then, of course, you have those that don't have any records, which may represent the healthier, younger population. And so if we want those folks part of our books of business at a carrier, how do we then leverage data to identify those folks and not having an EHR prevent them from getting insurance? But this is all, it goes back to what Colin said, this is all the ability to understand data, to feed data, do it in a way that allows, again, underwriting, as Colin said, the most important part of what a business does, those underwriters are still key. So how do we get those underwriters so comfortable with the approach that we take to provide them data, cleansing the data, validating the data, so that they can make that decision knowing that it's going to be their decision that's going to be on the books for 50 years. And that's the clients we serve. And that's where technology can make the biggest difference. And that's where you're seeing significant momentum just in the past 3 months, and that will continue for the months to come.
So that's a great point. And let's transition to somewhere else here. Earlier somebody said, it's need to haves and nice to haves relative to underwriting in order to get good underwriting decision and not make mistakes, right? How do you see, and I'll ask Trey first and then Colin, how do you see this relative to, and when I ask the question, I guess it's how streamlined will underwriting really get? I mean, when will we get to a point where underwriting is a day or maybe minutes? And how quickly can we get to that? So just real quick, because we've got a couple more things to cover here.
Yep, and I'll be so quick, and I'll use what Colin said before. There's a large percentage of all the policies underwritten today are preferred or preferred elite, probably 60%. So if we just focus in on that segment alone and not take away, we often get this noise in on these more complex cases. Those are always going to be complex. Those are always going to take longer. We want them to take longer so we can assess risk. Let's solve the preferred best first. Let's get to that day or day and a half. I think with what reinsurers are doing with automated underwriting platforms, data that's available today, introduction of VHRs, elimination of labs potentially can get us there, in the very near term. You see companies doing it today that are consumer direct or otherwise. So I'm thinking a year or 2 years where those decisions can be made. Colin?
Sure. Colin, what's your impression? I mean, how quick can underwriting really get done in the future? And how far away are we from that?
How quick can it, or how quick is it going to have to get done? And it's going to have to get done a hell of a lot faster than it is now.
That's a great point.
We're going to have to get it down, again, even in probably the most complex cases, to weeks, not months, doesn't cut it anymore. And for the most consumers, it should almost be instant. Now, two things I want to clarify. One, some companies have cut tech spending, others are doubling down, right? And it's not, I wouldn't, I would just hold one up as an example that I think is way out there in front of everybody. Is probably John Hancock, and with Vitality and everything they've done is just, it's incredible. Yeah. And sort of big data and stuff like that. So the other thing I mentioned, and just clarify one thing Trey said, and actually HIE data does have clinicians' notes. So again, you can, and the one thing with HIE data, one of the problems we have now, right, even ordering an APS, beyond the fact that it takes 2 to 3 months, is you're only ordering APSs on the doctors that your client remembered to mention, right? Sometimes they do forget 1 or 2, maybe the oncologist, somebody else. HIE data catches it all.
Yeah. Right?
It catches it all. And so the average HIE record, right, has reports from 4.5 doctors in it.
Wow.
So it's like a credit bureau. So once that actually starts to eliminate some areas of pricing mistakes in our group, within our industry, right? So this is stuff is there, and that's how you're going to get the time frames down to, for most people, it should be almost, a day or two tops.
So let's spend a second on that, because I think one
Yeah.
of the things we talked about the other day, which is fascinating, and it's come up on a number of these panels, is, today we have super preferred, super duper elite, standard plus, all that kind, and then of course all the substandards. We need to find bands, and the carriers try to put everybody into those boxes. And what I think I'm hearing here is a time when, we're going to get almost to, these are Trey's rates and these are Colin's rates based on what we're able to assess relative to your information. So you're getting not only bespoke underwriting or individualized underwriting, but individualized pricing. Do you see a day when we're going to get to that? Maybe start with Trey.
Yes, yeah. My response is that those conversations are happening with carriers today. If there was an ability to get rid of the class structure, which of course was back, CNA was probably the first to create the 6 different classes back in the early 90s. And then what you have is you've got people illustrating at different levels. You've got an illustrative competition game, and ultimately the risk of not living up to the expectation of the illustration is higher, which means you're going to disappoint a client and not have a delightful experience. So if there was an ability to keep the eye on that price for that client, the best price possible based on the help, I think that would be a desirable outcome for insurance carriers. Very complicated to try and implement. But.
Well, we're talking about the future, right? We're flash forwarding. So, Colin,
Okay.
what do you see?
Sure. All right. I might take it a bit further. I want to go, there's not only going to be Gonzalo's price, my price, Trey's price, Courtney's price. Okay. Is that price, you will have the ability to dynamically influence it going forward, which you have with John Hancock right now, right? Within the Vitality program, right? You can take your premium, and there's other carriers that have that out there too, but that's just what, most of your folks will be familiar with. So you can actually do that part today, share your biometric data.
Mm-hmm.
In terms of, can you have individualized mortality tables? The ability to do that is here now, right? I know one company that, and there's others that I mentioned this before, have access to the full Medicare, Medicaid database of Americans, both alive and dead. So that's over 400 million people, okay? And you have all their medical data, right? So I can match anybody up to certain criteria against that database, and I can return that. They can return the information as fast as you can snap your fingers.
Yep.
And what's fascinating about that, because you may go, traditionally we go, okay, somebody had this condition, a heart attack, whatever. They're now a bad risk. Well, that's a bias, but that's not based necessarily on fact, because you can now match people who have had heart attacks on certain drug protocols, and maybe they have other things, against everybody in that 400 million database. And I can assure you what you're going to find is you're right about half the time, but the other half you're wrong. And we may be turning away risks that we should accept, and we're underpricing some risks that we do. Yeah. And that kind of data and the ability to do that is here now. And some of where you're out there, where I see it out there right now, who's adopted it, again, it's on a bespoke basis. It's the life settlement writers.
Yeah,
they figured it out, but the big carriers are going to figure it out too, right? It's there.
Well, we have about 15 minutes left, and I do want to take a couple questions towards the end. But so let's try to have a little fun here with the tech stuff that's coming out. And we've had conversations about biometrics. We've had conversations about Vitality was mentioned. I mean, there's a lot of other cool stuff that's going on that's really going to impact not only the way we underwrite today, but the way we keep clients engaged, and we get biometric data, and we're able to then help them almost create their own pricing relative to insurance on a going forward basis, right? So, let's talk about engagement and wearables. And, Trey, you were at Hancock, and, when Hancock rolled out Aspire for people living with diabetes. So talk about that a little bit, because I think that begins to have an impact on where some of the not only the present underwriting assessments that we can make today, but how we can track people and work with people to really give them the right experience relative to pricing and maybe even engagement with their insurance.
Yeah, and I would say we shouldn't underestimate the willingness of people, particularly younger generations, to share data if it brings value to them. And in the form of, acquiring insurance or paying for insurance, there's definitely a significant trend, and it's proven that those folks are willing to share. And of course, we know that, it's very few people now that don't have the iPhone in their pocket or an Android walking around tracking steps or wearing a Fitbit or wearing an Apple Watch. I have the Tag Heuer digital watch that does the same exact thing. So, whether it's the device that you're wearing, which I think we have to be a little bit cautious, you don't want to tie the future to the devices. It goes back to the data. There's tons of data that's being collected that people are willing to share. And that should make our ability to create a better experience, collect more data up front, and to Colin's point, collect data along the way to make sure that we've got engaged customers post-sale that can help support the objectives that John Hancock laid out so effectively, which is let's help our clients live longer, and that benefits the insurance company by extending mortality, which has a significant benefit to insurance companies. So look, this is one of those exciting opportunities where we can leverage this data to create win-wins across industry and clients and really create products that are far more creative and innovative than we have today, which is required based on some of the pricing challenges. So I'll let Colin address some of the specific technology areas, but there's no doubt that we're going to have more and more data available than we've ever had before, thanks to some of the technology.
Yeah, and Colin, I don't even have to encourage you to talk about the tech side and wearables and engagement. I mean, you told me right before the call, my Apple Watch is going to save my life. So yeah, tell everybody about that, because that's probably one of the coolest things I've heard in a while.
Okay. Your Apple Watch is going to save your life. And by the way, your Fitbit can do it too, and your Garmin. Okay.
Yep.
For anybody who sort of doubts this, and I'll go back to what Trey said with John Hancock. And by the way, I would call Vitality, Aspire, game changer, right? The game changed for their policyholders. The game changed for the company. And now they use electronic health records, which, by the way, right, they'll order on your behalf, Gonzalo, so they can issue a policy for you a lot faster than a lot of other carriers. You can decide where your business is going. Now, for the Apple Watch, one of the interesting debates is, what is it? Is it a watch? I got a partner who talks in his all the time. I don't get that. Run an EKG for you. Okay. But it is, and again, it's a Fitbit, a Garmin, the watch Trey has on. Okay. The types of data. And so, one firm that True Health Catalyst were involved in called Cardiogram. It was created by 4 voice recognition engineers out of Google. This is your Silicon Valley thing. It's got over 2 million users today around the globe, not just in the United States. And off the watch, and I said, as fast as you could download the app, because you've had your watch for 7 days, or if you had a Fitbit, doesn't matter, or a Garmin, it can diagnose, I won't use the word diagnose. It will, I sort of think of it as a check engine light will go on that will then suggest you talk to your physician, right? Doctors make diagnoses, devices don't. About 4 primary conditions. Sleep apnea, which 80% of people have it, don't know they have it, and that can kill you. Hypertension, we all know that can kill you. About a third of people have that, it's undiagnosed.
Yep.
Atrial fibrillation, a huge one in underwriting.
Yep.
Again, about 30% of people have that, it's undiagnosed.
Yep.
Okay. And diabetes. And pre 1 and 2. And who would have thought off your, and what it does is it detects your heart rate. And off your heart rate and your blood, right, that changes if you have diabetes. Now, it's also as unique to you as a retinal scan. So if you want to give it to Trey, it knows, right? You can't fool the device. Yeah. But it can detect for you that. And so, you heard, I said it somewhat tongue in cheek, but I'm not kidding about this. Having a heart attack is basically like paying estate taxes. It's a voluntary thing. You choose to do it, because for most Americans, with this type of biometric data, and again, if you want to share with that insurance company, great. If you don't, that's your business too. but it can save your life because your check engine light's going to go on, right? And alert you. Now you may ignore it like you do the one on your car, but it can save your life.
Well, Colin, it's interesting. My business partner is a physician and has been underwriting for years and years. And Dennis says the first sign of heart disease is death. It's like most people, to your point, are don't know, are undiagnosed, and their first start of heart disease when they fall over of a heart attack. So it's this watch could potentially save your life. But we're not here to talk about that. We're here to talk about, how cool the fact that is that this technology now begins to not only save your life potentially, but also provides, the efficiencies and the improved mortality, hopefully over time, so that the pricing pressure and, especially in today's environment, doesn't absolutely bring these carriers down to their knees. So that there's a lot more to unpack there. So, give me a little bit more perspective. And I'd ask you to comment and Trey to jump in here as well on some of this stuff.
I mean, Gonzalo, all you need to know is Hancock will sell you that mighty fine Apple Watch for $50, right? I don't know, Trey, maybe you know what they're buying them from Apple for, but I know it's a lot more than $50, right? And Hancock thinks this is the greatest thing they've ever done, right? They are helping people's lives. They're obviously helping themselves, in terms of experience, right? So it clearly makes sense to do that, right? Yeah. But it has created that, this creates a win-win, right? It's an enabler for you as an agent, right? When this kind of data is there on your client, because they can also come back and you can do the upsell, right? Because if they've been sharing their data, not only do they get a premium reduction, right? From Hancock or some other companies, right? They stay more engaged, but you're almost real-time underwriting, right? Not for everything, but for an awful lot of conditions. And again, that's just, more and more and more as these devices get more sophisticated. Not everybody has one, but an awful lot of people do. Yeah. Right? You want to make a better experience? It's easy. Yep. And again, you don't have to share the data. It's up to you. Sorry.
Yep. And I even think about the, millions of people we have on in-force books across this country and the way that the technology and wearable can really help that in-force book create a better engagement level. So Equitable is doing with diabetes. They're handing out, they give monitors to folks that have been diagnosed with diabetes to help get that data in more streamlined. There's compliance on how people take medication. There's just these habits. And if you're consistent taking your medication, you're a better underwriting risk, which allows you to do something later in the policy year. So it goes back to dynamic pricing, engagement, and experience, leveraging this data that people are willing to share. So it's there, and it's, we need to embrace and adopt this so that we can really move the needle.
Well, and it helps our clients, right? You're helping your clients. And again, I know, I remember Brooks Tingle from, Hancock talking about what people will do to kind of spin the wheel and get the free latte is amazing to me. And I gather the wealthier the person, the more engaged they get, they love free stuff. But again, people who did do that, I can think of one case, went in and had a mammogram, and lo and behold, this had a happy ending, but that woman wrote to him and said, "You saved my life." Yeah. Right. And it's because I had the Apple Watch, because I'm engaged in Vitality, because I'm on this system, right? Good for him. No death claim. Obviously great for her. Yeah. Right. Well, that's a win-win.
Look, I mean, we've talked about a lot of stuff here, but I think that what I'm seeing, at least from my vantage point, and thank you guys for sharing what you guys are seeing, is we're at a point in time where, we're distanced. There's a lot going on in the world. The economy is putting a lot of pressure on these companies from a margin standpoint. We need to find efficiencies, and we're getting there. I think it looks like we're getting there pretty quickly. All of that is going to make this insurance a product that will be easier to own and more engaging longer term relative to, the other surrounding things around it. Well, again, whether it's wearables or a cardiogram or some of these other things that are out, Aspire. There's a lot of innovation going on here. So we really need to stay focused on that. And I think that underwriting, as you guys said, underwriting should not be as complicated as it is today. And big data is going to save the day.
It's going to help. And by the way, you're seeing the engagement platforms also with the health insurance, right? It's not
Yep.
just our industry. Go look at your primary health insurers, all the majors, they're sort of probably ahead of us on this, right? Because, they can reprice every year, but, so they don't have to be maybe as cautious when they underwrite. But they've also, they're way down the road embracing it. And the other thing that I would say with technology, again, coming back to the producers on this call, right? Let's cut to it. Those companies that are going to become tech enabled, to make it easier for you to do your jobs, make it easier for you to sell a policy to a client.
Yep.
You tell me who's going to get your business.
Yep.
Right. And that's what I see right now. It's not going to be interest rates that separate the winners from the losers. It's going to be tech.
Yeah.
Tech.
I think that applies to so many industries. Well, listen, I think we're kind of approaching the end of our hour here. I do want to take some questions from the audience. We do have one already, so I'd like to ask you guys, and this may be for, well, probably either one of you could answer this. Has anyone actually successfully increased life COI, so cost of insurance? Everything I have seen seems to point to reluctance on part of regulators to approve the COI increase, at least on UL. I know of a few companies that have had increases. Maybe you guys want to elaborate on that a little bit.
Trey, do you want
Yeah, okay, I'm happy to start.
to?
Have you fill in the gaps? I mean, obviously, the COI increase is the course of last resort for all carriers. Every carrier knows that. They don't want to do that unless it's absolutely required. There have been instances where they have released increased COI successfully. That's primarily in policies that may not have a direct impact. They may be longer guaranteed policies. It's certainly not done at every carrier and industry. And there are lawsuits that are contesting some of those COIs. So I don't think it's perfectly clear yet what carriers can and can't do. Contractually, it's pretty clear from the carrier perspective, but there have been some successful implementations of COI increases. Colin?
Yeah.
Colin, before you jump in, I would just remind the audience that there is a Q&A button on your screen. If you have any questions, we are taking some questions now, so please type them in the Q&A box. Colin, back to you on price increases, especially COI increases.
Well, as Trey said, it's the lever of last resort, and it's not one that carriers pull easily, and that should tell you the pressure that they're under, right? I mean that's read between the tea leaves. There's another one that's out there too, enhanced cash surrender programs, right? I think you've seen that from a few carriers, because they don't want the life settlement companies stepping in and keeping those policies in force. Right. So again, and you've seen on the VA side, let's not just pick on life. You've seen buyout offers, right? Again, Trey's former company, actually, one of them did that too. So you've seen that, the buyout policies. So there's a bunch of things out there, right? But if you want to look at what really caused this, I'll walk it right back to the beginning. It's the pressure from low rates, and that, are rates ever going to go up? What does anybody want to project on the 10-year? 1.5, 2, maybe the long-term rate, 3 if you're really feeling bullish.
Well, and I think the point that you made, Colin, is important. Though I don't think anybody could sit here and argue that that mortality or that longevity has gone down, or that life expectancy has gone down. That true cost of insurance really hasn't gone up. It's just everything else around it that's driving the bundled portion of these products. It's the only lever they can pull, right? There's nowhere else to go. So the idea of increasing COIs is not indicative of reduced longevity.
No, not at all. It's what can you pull?
Yeah.
You're running out of options. That's why it comes back to technology, expenses, right? That's the lever you got to move right now. COI is the last thing you guys tell me you ever want to touch.
Yeah, and Gonzalo, it's usually one of the best benefits that have been offered, of course, is the long-term care rider added on to the life insurance contracts. And that, of course, is also increased persistency, right? Which is another potential pressure, but still one of the best benefits that you can have in a life insurance contract.
There's no doubt.
Yeah.
There's no doubt.
Well, and Gonzalo, this is an opportunity for our industry, right? It's, we all talk mortality, but the other side is longevity, right? Ensure your client's longevity, right? The value of mortality pooling, right? When we're in this low forever interest rate environment, it's not just insurers that suffer from it. It's every one of us who's got an IRA, right? In a retirement account. That's when mortality pooling comes in the best. If everybody knew when they were going to die, it'd be easy, right? Piece of cake. But right.
This will tell
That's
you, right?
that's why your longevities, you start insuring your longevity, not just your mortality.
My clock is ticking.
Yes.
I think I have one more question here. Amazon will get in the business and issue a policy while the buyer is completing the app and issue it immediately after doing some electronic underwriting. They'll prospect for buyers by saying to a customer who bought diapers that people who bought diapers also purchase life insurance. When will legacy carriers do this sort of thing? Trey, you want to take a first swing at that?
Yeah, and I'll be quick. I know we're out of time, but there's no doubt. And I think that what we talk about with data and the ability to get that lifestyle data to help support lead opportunities and sales is critical. So there's no doubt that insurance companies are headed down that path to create that type of experience. We know our clients better and can offer the right type of coverage, amount of coverage, fits nicely in the best interest clause and everything else. The question about Amazon getting in the business, and look, I don't want to be too short-sighted here, but the regulations and the barrier of entry into this business are so high. I'm guessing that Amazon is going to look to make money in much different types of industries that don't have a high cost of capital, very low return. And I'm not suggesting they can't help participate in different experiences, but I'd be surprised to see an Amazon or a Google jump all the way in as a manufacturer or product creator.
Colin, you want a last comment and we'll wrap on this?
Of course, we might have said that about Apple with phones, right? And a lot of other things. But I build on what Trey said. Whether or not they actually want to get into owning an operating company, there's a lot of other ways to skin the cat, and to partner with companies. And I would think of the Apples, the Googles, why not some of the big banks too? Because they get the longevity opportunity, right? It's a chance to run money for a long time, right? And by the way, if they want to keep some of the underwriting profits, okay, Trey and Gonzalo, look how M does it. They got their own reinsurance company, so you can follow that model, right? So it's easy to sort of, in a way, get in the business without having to go whole hog and as a primary. So, but that's when I think about who the competitor, who we want to watch looking out there, right? It's going to be the tech-enabled companies that we see in the business today. And there's going to be some new competitors come in because they see that post-retirement longevity opportunity. Yeah.
Well, this has been a fascinating conversation, gentlemen. I want to thank you both on having this one with me about, the future of underwriting, what's going on. I'd also like to thank the audience for their participation. And I want to remind everybody to become a promotional member today. You can join AOU or Gamma under our promotional membership tier and to receive your exclusive member benefits for a low cost of $500. You can do that on the ALU.org or gamma.web.com website. Please remember to visit the COVID Action 19 Center on AOU and Gamma websites. I want to thank everybody for being on the call. Colin and Trey, thank you guys for your time, and everybody have a wonderful day. Thank you.
Thank you, Gonzalo. Thank you, everyone.
Bye-bye.